Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us from Macro Tides. It's Friday, and we just came off of a non-farm payroll, Jim. We're actually seeing some pretty big volatility. Let's instant reaction to the data. Data was better than expected, and the market sold off a little bit. They're recovering right now, but what do you make of this?
Okay. Well, first of all, I'm going to offer listeners, Blake, the December macro tides that just went out yesterday. Just send an email, Jim Welsh Macro, and I'll send it out to you because I go through the labor market in detail and why I think a recession is coming, and it does pertain to unemployment and so forth. So obviously the labor market continues to exhibit a lot of strength, wage growth over 5%, job growth pretty good. And Powell told us on Wednesday, even though the market chose to really misinterpret his comments again, that the labor market holds the key to core inflation. And these numbers obviously suggest that the Fed, and not doing anything different. I still think they go 50 basis points in December. The key thing that the market hasn't recognized, that they're going to hold the funds rate, at least they intend to, through all of next year at 5% or wherever they're at.
Yeah.
And what that means is we're going to have a recession, in my view, that develops somewhere around mid-year next year. And I don't think Wall Street fully comprehends that. But that will become more clear as we get into, the first few months of next year.
Well, so okay, I get what you're saying, Jim, and I hear the rub, but why are the markets recovering following the data? Because if the markets feel that rates are going to, well, let me ask you this. I guess what the market is saying right now, because of the recovery following the jobs report, is that the Fed won't keep rates at high levels. They're going to just do what they always do and buckle at the knees and cut rates.
I'll come back with a little different response.
Okay.
The strong jobs report means that the economy is less likely to experience a deep recession. We're going to get a soft landing. Everything's going to be perfect, don't you know? And so as a result, you don't want to sell stocks here because earnings aren't going to get hit that much. Do you know that right now earnings are still slated to be, Wall Street consensus, up 9.5% next year? I just don't think that's going to happen. Blake, it's that simple. All right. So I think markets are choosing always, as they've done this year, to try to ferret out whatever bullish scenario they can come up with. Here's, I kind of made a synopsis of some of the comments that Powell made. He said, hey, core services is more than half of the core PC index, which is his favorite inflation metric. The labor market holds the key. We have this rather significant shortfall, and it doesn't look like it's going to ease up anytime soon. What he referenced is that you need to keep the labor market in balance with population growth. All you need is about 100,000 jobs. So he's telling us that at a minimum, you need monthly job growth to drop below plus 100,000. And obviously wage growth is way above the levels that would be consistent with a 2% inflation rate. So that's the rub. And over the last month or two, as we've talked, I've said, listen, everyone's focused on inflation. It is going to be coming down, especially as we get into the first quarter of next year. But the key from the Fed's perspective is the labor market, because wage inflation is so much more important than, gee whiz, look at goods inflation's coming down. Yeah, is that a good thing? Yes. But from the Fed's perspective, it means that they need to lean a little harder, maybe more importantly, lean harder for longer. And this is what the market hasn't understand. If the Fed wants to get inflation down, and in the December macro tides, Blake, I go through, we almost have to have a recession. If the Fed is serious about bringing inflation down towards 2%, we almost have to have a recession. And I would point out, we talked last week about lending standards tightening, the leading economic indicators down for 8 months in a row, and the yield curve is inverted almost. I think 81% of the curve is now inverted. Yeah. So all those things are strong recessionary signals, and I think that's where we're headed. So
well, then if we're going to see it, we're going to see a recession. Maybe that's why stocks again are up today, because they feel that in a recessionary type of environment, the Fed is going to have to try to induce a little bit of life into the market by maybe lowering rates. But you don't think that, do you?
Well, what I think is that there's going to be a window of time in the first half of next year where we get decisive information that the economy really is slowing down, and the Fed is not going to budge. So you have this 1 or 2 month window where, geez, we're getting bad economic news, and the Fed is still saying, hey, we're going to keep the funds rate, at this level because we want to be convinced inflation is coming down. In that 1 or 2 month period, could you drop 15% or more in the S&P? Yeah, that's typically how it's worked in the past. So I just think that until we get to a place where the Fed legitimately can not only stop raising rates, but actually is at a point in time where they, 3-4 months from now, we can develop a scenario that, hey, the Fed's going to be lowering rates. That's when you want to become bullish. We're not even close there. Okay. And Powell said, this is going to take a long time to accomplish. And the jobs report, to me, just reaffirms that statement.
Okay, well, let's talk about how that equates to the dollar, because the dollar has been, the dollar's actually sold off a little bit following, even your chart right here.
The knee jerk. Right.
Yeah, we've got a big knee jerk reaction, and we've got the euro back above 105, and the dollar index is slumped a little bit here. But is this a complete wave 5? Is that how you're seeing it?
What I'm looking at is that, and we talked about this last 2-3 weeks, 1-2-1-2, big drop down on the November 10th CPI report. What that pattern suggested, we were going to get a 4-5-4-5, which is exactly what's unfolded. The alternate pattern count, if you will, is that the that first rebound from wave 3 to top of wave 4 was wave A. We have 3 waves down for a B wave, and then a C wave rebound would take us back near the highs of where that wave 4 was, which is, call it 107.50 or so.
Oh, sorry, I went too far.
Yeah.
Okay.
The flip side is, we got 5 down, and we're going to retrace a percentage of the whole decline from 114.77 to the low, I think, was at 104.30 something. And, for a long time, I've been talking 104.50, 105. We did that. So my point, there's either count suggests the dollar is likely to rebound in the next window of time, as I think markets start to kind of maybe digest that, wait a second, the Fed is not going to be caving as quickly maybe as people thought, based on Powell's speech on Wednesday, which again, I believe markets misinterpreted his comments, which has been a pattern all year. So to me, a rebound in the dollar back towards where it was a week or two ago, and I can't see the number where the
about 108 maybe somewhere.
Yeah, 108. So 107.50 to 108.
Yeah,
I think that's and that's the least bullish pattern. The more bullish pattern is 109.37, and remember 109.20 was kind of an important number.
Yeah, right over here.
So that makes sense to me. But again, the point being is one count or the other, both suggest the probability is we're going to see a rebound in the dollar over the next week or two.
We have gold. It's pulling back. I mean, gold, a little scary because we have a little bit of a false breakout today, right? I mean, that's a little nerve wracking if you're a gold bull, right? Yeah.
Well, again, my expectation was, for weeks when we were talking in October, hey, I think there's a rally that's going to take the gold up to 1750, 1780, and you might get a push a little bit over 1800. And when it got above 1770, to me, is okay, this is enough of the rally. It hit the target, time to take chips off the table. We had a modest pullback, and then the spike up, to me, again, says that you could have an ABC up here, completing. And so from the high last March at 2067, as you can see, 1, 2, then 1, 2, 3, 4, 5 for wave 3. And this has been nothing more than a big ABC up here for wave 4. So at a minimum, a 50% retracement gets you back down to that 1710, 1720 range, or it's going below 1616.
I was going to say,
if
this is for wave 5, I mean, we might be way over here.
Yeah, exactly. But again, scary. My point is, both counts that seem likely suggest you're at the forefront of a pullback. that I think it is at a minimum, and gold goes down towards 1720-ish and potentially even lower than that.
Okay. All right. All right. Well, let's moving right along here. What does that mean for treasuries and
Okay.
yields? I mean, because
So,
the bond market has been in absolutely bonker trading mode
Yep.
and rally mode. So what do you make of it here?
Well, again, you have 5 down in treasury yields on the 30-year. So
Yeah.
that implies you're going to get a retracement of this move down. That green trend line is something I had there weeks ago, saying this is where I think yields can get to. So at a minimum, I think we're going to see a retracement. And the 50% retracement is 4%, about 40 bips. The 382 would probably be closer to 390. But at a minimum, it suggests you're going to get a retracement uptick in treasury yields. Now on Monday, as you know, I was long TLT.
Yeah.
Before the opening on Monday, I sent out a special report saying time to sell TLT. It opened at 103.60, traded up to 103.81. So we missed the last day or two spike. But if I'm right about this pullback, which is why I said, hey, I think we're near the end of wave 3. Let's sell into that strength. I think we're going to see yields tick higher. So you can see you've got completed patterns happening here, potentially in the dollar. Gold, one just calls for a pullback, one is more bearish. Bonds calls for yields to uptick. So all these patterns seem to have reached a completion in the last couple of days and suggest we're going to see retracement moves against the trend that has been in place the last, few weeks.
Well, before we get into that and before we get into the S&P, I just want to say that if you guys and gals like what Jim does here, make sure you give him a thumbs up. Make sure you subscribe to this channel, the Trader Summit channel, so you don't miss any of this exclusive content that we have every week. So Jim, let's talk a little bit about the S&P. So
okay,
we've been rallying for weeks, and
yes,
some pretty big resistance up here.
It is, and as again, I was looking for a rally after coming off that low in mid-October. I thought there would be a pullback towards 3,700 based on Powell's comments on November 2nd. That's exactly what happened, and that we would see a rally to 4,050 to 4,150. Now, again, when things start getting long or stretched, I recommended saying, hey, let's sell into strength when we can. If the S&P gets above 4,009 or 4,028, lighten up. So we got this pop based on Powell's, what I again believe were misinterpreted comments on Wednesday. And this, an ABC up from 34.92, C would equal A at 41.12. The S&P got to 4,100. So again, you've got a 3-wave rally here, an ABC up that at a minimum implies a pullback, that a 382 retracement gets you under 3,900, the 50% gets you close to the 3,800, and we'll see. If it's a 3-wave decline, Blake, then we're going to see another push higher. But right now we don't know that. Yeah. What we do know is that potentially the market has to understand that the Fed is committed to raising rates more and then holding there, and that's not great for the market. That's not bullish. But we'll see what kind of a pullback. The seasonality suggests a pullback into mid-month is often the case in December, and then you get another push going into year-end. So I think there's the potential that over the next week or so, you get a pullback towards mid-month to that under 3,900 towards 3,800, and then we'll see, like I said, if it's a 3-wave, that's corrective, that suggests there's going to be another push higher. Just don't know if that's going to be the case.
Okay, well, we're in that quiet period with the Fed, and people are going to have this weekend to really think about that jobs data that we had, and I mean it means that everybody's going to be watching data as it comes out very, very carefully between now and the FOMC meeting. Is that correct, Jim?
Yeah, and what will be interesting, Blake, is to see if the percentage probability of a 75 basis point hike at the December meeting, if that starts to tick up, I think the markets start to react to that. Now, again, I'm in the camp, and I was before the CPI came out on November 10th. I think the Fed's going 50 basis points. They need the cover of a good CPI report, which I expected to happen. They got it. I think the next CPI report is likely to be constructive as well. So again, the Fed is downshifting, which makes sense. But what the markets have failed to really factor in completely is, yeah, they're going to nudge the funds rate up a little bit more over the next 2-3 months. But more importantly, they're going to hold it there. They don't want to jam on the brakes and cause an immediate recession, because that would force them to reverse course. They want to get to a modestly restrictive level. And then it's kind of like, you're going down a hill. They don't jam on the brakes. You just gently put the brakes so that the car slowly decelerates. That's what the Fed is trying to accomplish. People want to believe that a soft landing's coming. And I just think the probabilities of that aren't as high as most people believe and want to believe and hope. Again, what typically happens is that right at the end, things get more weak. They kind of hit a critical mass, and all of a sudden, you're losing 100 to 2,000 jobs a month. And that's what I think the market is going to have to deal with at some point in time. That's that window of vulnerability when, we're seeing more decisive, softening data, and yet the Fed is giving signals that we're not ready to change yet, folks. That's where the markets, I think, are going to be most vulnerable, but that will create the buying opportunity.
All right, Jim. Well, I appreciate your thoughts, and I know the community here at Traders Summit really appreciates your thoughts as well. So how do we find out more about what the great Jim Welsh does?
Please. Or at least make it a small G, okay? Macrotides.com, Jim Welsh Macro at Gmail. As I said, you send me an email, I'll send you the December Macro Tides, and I think you'll get an awful lot of information and understanding of where the Fed is and what's likely to happen in the next few months.
That's phenomenal, Jim. I know I got Wednesday. I got an update from the great Jim Welsh myself, technically, which is awesome. It's always awesome to have, and I know your users and your subscribers do appreciate it. So thank you so much for joining us this week. We'll see you next week.
Sounds good, Blake. Have a wonderful weekend.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.